Here's one undeniable truth. Most people waste their first $1,000 or even go broke trying to get rich very fast. They don't fail to build wealth because they're lazy or stupid. Now they fail because they chase noise instead of following proven systems. They're overwhelmed with stock tips, TikTok's crypto bros, and clickbait headlines. But what if all you needed was a repeatable system and just $1,000 to start? Now this video isn't financial theory. I'll show you how to use my 2-ETF system to build generational wealth, and by the end, you'll be able to easily copy it. I'll also explain the reasons why I chose these 2 ETFs over everything else, and lastly, you'll discover the strategy I use after investing $1,000 to reach $1 million. Now if you don't know me, my name is Ace, and 10 years ago, I was just like you. I had saved up $1,000 to start investing, and I was so excited. I felt like it was a big deal, and finally, I could start investing. So I did what most people do. I opened up YouTube, I typed in how to invest, and I fell straight into the finance rabbit holes. There were tons of videos everywhere. One video saying, buy Tesla now before it's too late. Another one saying, crypto was gonna go 100x. And then I found one guy saying, ETFs were the way. But he had like 20 or 30 of them. So the more I watched, the more confused I got. And I was frozen. I didn't know what to do, so I ended up just putting all my money into crypto, of course. And after a few months of panic buying and selling, I lost all my money. I wasted my $1,000. And looking back, I bought in when I had no clue, zero clue who to trust and what I was doing. And that's when I realized one thing. Most people don't fail at investing because they're lazy or dumb. They get lost and fail because they don't have a system. The problem wasn't my money. The problem was that I had no framework, no strategy, just opinions and hype. But then out of nowhere, in the back of an investment book that I bought from the bookstore, I saw this one quote from Warren Buffett, the most successful investor of all time and the richest person at one point in history. He said, a low-cost S&P 500 index fund alone will outperform most strategies and 90% of investment fund managers. And that hit me hard. I didn't need to be the smartest person in the world. I just needed a repeatable, proven system and just to stick with that system. So do remember this. Smart is sexy, but boring builds wealth. So I started digging. I studied the most reliable ETFs. I looked at what most long-term investors, not influencers, were actually doing. And I kept asking, if I had just $1,000, what's the simplest way to build long-term wealth? And that's when I landed on what I now call my 2-ETF system. I tested the system, I bought into those 2-ETF system, and started contributing $1,000 every single month. I watched the market go up and down, but I didn't panic. And for the first time in forever, I felt I was in control. There was no FOMO, there was no stress, just quiet confidence that I was finally building wealth the right way. And here's the crazy part. Once I stopped trying to get rich fast, I started seeing results so much faster. My account grew from $1,000 to $10,000 to $300,000 in just 2 years. And that's when I know this system actually works, and not just for me. So here it is, the 2 ETFs that helped me build my wealth that I would use if I had to start over with just $1,000. And in the next section, I'm going to show you exactly what they are, why I picked them over everything else, and how you can copy this simple strategy to grow real wealth without guessing, stressing, or even gambling. But first, a quick disclaimer, I am not a financial advisor. Everything I share here is just my personal opinion for education and entertainment. Always do your own research before investing. So here it is. The exact 2 ETFs I would use if I were to start over today with just $1,000. ETF number 1, SPY, the Spider S&P 500 ETF. This one is your foundation. With just one ETF, you're instantly invested into the 500 largest US companies, from Apple to Microsoft to Costco to Johnson & Johnson. So think about it. When you buy SPY, you're buying a slice of the entire US economy. You're not betting on a stock, you're betting on the engine of capitalism itself. Warren Buffett himself literally told his own family that if anything ever happened to him, they should just put 90% of their own money into an S&P 500 index just like this. It's low cost, diversified, boring, and proven. And you know, boring is beautiful. Boring is beautiful because it builds wealth that you can count on. ETF number 2, VGT, or Vanguard Information Technology ETF. Now this one is your growth engine. It's focused entirely on the US tech and innovation. So companies like Apple, Nvidia, Adobe, and Visa. So while SPY gives you the full market, VGT zooms in on the fastest growing sector in the world, technology. And over the last 10 years, VGT has outperformed most other funds, but it's more focused and more volatile. And that's why I don't put everything and all my money into it. But when you pair this with SPY, it adds rocket fuel to a rock solid base. So here's exactly how I would split it. Firstly, $600 into SPY for long-term consistency and broad market exposure. Second, $400 into VGT for innovation and higher upside. And that's it. No need to watch charts, no need to time the market. You've now got exposure to 500 plus of the most dominant companies on earth and the tech leaders building the future. Now you might be wondering, why these two? Why not a dividend ETF or a total world ETF? Why not just put all of them into tech? Very fair question, because there are hundreds of ETFs out there and most of them sound great at first glance. But here's the criteria I used to choose only these two. Now first of all, the reason why I chose VGT and SPY isn't just about past performance. It's about how they work together in different market conditions. Now VGT, which is a tech ETF, gives me exposure to the technology boom, being AI, cloud, semiconductors, cybersecurity, and fintech. All the sectors driving innovation. And let's be honest, in every bull market, technology leads. So just look at the last 200 years, companies like railway, cars, IBM, Nvidia, Microsoft, and Apple literally carried the market. But when things actually slow down in more recessionary scenarios, that's when SPY actually shines. It holds the entire S&P 500, not just tech, but sectors like healthcare, consumer staples, so think markets, supermarkets, commerce, household goods, defense and industrials, even energy and bank sectors. These are the sectors that can stay strong or don't get hit as hard when technology takes a hit, like during recessions, interest rate hikes, or political uncertainty. So what happens when you combine the two? You've got a strategy that works in up markets and stabilizes more in down markets. Growth when the market runs and less volatility when it doesn't. But all of these are not just theory. They aren't just some made-up strategies I pulled up from a blog last night. These two ETFs, VGT and SPY, have been battle-tested for years, and the performance data proves it. And I didn't just want something that performed well last year, or last night, or last 2 years. I wanted ETFs that have shown decade-long strength through recessions, crashes, and booms. Now let's start with SPY. Now SPY has crushed most mutual funds and even hedge funds over the last 15 plus years. Now I could have picked any of the big S&P 500 ETFs, being SPY, VOO, or even IVV. They all track the same index. But here's why I chose SPY. Over the past 1 to 3 to 5 or even 10 years, SPY has consistently outperformed the other two. Since its launch all the way back in 1993, it's averaged over 10.5% annually through booms and busts and everything in between. It's also the most liquid ETF in the world, meaning tighter spreads, easier tradings, and more confidence, especially in volatile markets. So while all three are solid, SPY is the original, the most battle-tested, and the most consistent over time. Now in terms of its tech counterpart that I have chosen, VGT has doubled the S&P 500 in terms of performance in the last 20 years and has consistently outperformed the other tech-focused ETFs thanks to its exposure to real innovation leaders. Now to compare, I look at three top tech ETFs being VGT, XLK, and IYW. Now they're all strong, but only one consistently wins across the board. Over the last 10 years, VGT delivered over 21.5% annually, beating the others while giving you broad exposure to over 300 companies in tech, and not just the big names. Now, XLK and IYW are good, but they are either more concentrated, had weaker long-term returns, or higher fees. And when you're building wealth long-term, consistency beats hype every single time. And that's why I went with VGT. The data makes it the clear winner. Now, some of you might be wondering, why not just go all in on AI? Why not choose an ETF like SMH, which focuses purely on semiconductors and artificial intelligence? And that's a very fair question because I had the same thing on my mind. SMH does deliver massive returns recently, especially with Nvidia leading the charge. But here's the thing, SMH is very narrowly focused. It's mostly semiconductors, which are crucial for AI right now, but that doesn't mean they'll be the primary driver of the next tech cycle. Now, technology changes very fast. 10 years ago, people were betting on social media and mobile apps. Before that, it was the internet boom with Yahoo and Google, and before that, it was personal computer and Microsoft. AI is powerful, and I do believe it will be here in the long haul, but I don't know for sure if AI chips will still be the biggest winners 5 years from now. That's why I chose VGT. It gave me broad exposure to all major tech sectors like software, hardware, fintech, cloud, cybersecurity, and yes, AI and semiconductors as well. So no matter what direction technology takes, VGT lets me ride the wave without trying to guess which board to stand on. And another reason why I picked these two, SPY and VGT, is because of their ultra low fees. A lot of people don't realize this, but over 30 years, a 1% fee can cost you tens of thousands of dollars in lost gains. And that's money you earned, but it quietly disappeared into someone else's pocket. SPY and VGT has some of the lowest expand ratios in the whole ETF industry, only 0.09%. That means if you invest $10,000, you're paying only around $9 a year in fees, all automated and managed just for you. No need to time the market, check charts, or even chase tips. A system you can set and forget and grow. Now you compare that to actively managed funds charging 1 to 2%, where you're paying hundreds or even thousands a year, even if you lose money. So while the strategy is simple, it's also lean and efficient. Your money works for you, not for a fund manager's bonus. But the real secret isn't just about choosing the right ETFs. It's about what you do after the first $1,000 that makes or breaks your future. So in the next part of this video, I'm going to show you the simple strategy I follow after investing the first $1,000, the part that actually turns it into 10K, 100K, or even $1 million over time. Now it's not flashy, but it's the part that most people skip, and that's why they stay stuck. Wealth is built through repetition. I always say, fortunes aren't found, they're compounded. Step 1, set up monthly contributions. Pick one amount, even if it's only $50 or $100 a month, and automate the whole process. This builds your habit, and that habit builds the wealth. Step 2, reinvest your dividends. Both SPY and VGT pay out dividends. So turn on DRIP, which is dividend reinvestment, so those payouts go right back into buying more shares automatically. This is where compound growth starts accelerating behind the scene. Now let me show you why this matters with one simple example. Say you invest $1,000 into SPY, and it pays an average 1.5% dividend each year. That is $15 a year in dividends. Now that might not sound like a lot, but if you reinvest that $15 and do it every year, that money starts earning returns too. And over 30 years, just from reinvested dividends and compounding, that $1,000 could turn into over $10,000 instead of $7,000 to $8,000 a year if you didn't reinvest. Step 3. Now you have to zoom out. Check in on your portfolio maybe once every 3 to 6 months, not every day, not every week. Why? Because real investors, they think in decades, not days. When the market dips, and it will, trust me, you stay the course. Because every single time the market has dropped, it's recovered and hit new highs. So if you do follow this, you'll be doing better than 90% of investors, including the ones that think they are smarter than the market. You're not trying to get rich fast, you're trying to get rich for sure. So now if you're someone who's already understands the basics and wants to think long-term and time cycles like pros, let me leave you with this. There's a powerful macroeconomic pattern called the 18.6-year real estate cycle, and it's been accurate for over 200 years. And every major boom, bust, and recession has been lined up with it, and it has predicted every single major crash like the Great Depression, the dot-com bubble, GFC, and COVID crash. So why does that matter for ETF investors? Because different parts of the economy dominate at different phases of the cycle. And if you learn how to identify the phases, peaks, and troughs that we're in, you can rebalance your portfolio, tech, real estate, commodities, and infrastructure, and potentially 10x your return over time. It's what the banks, the wealthy, and the institutions already know, but they never teach. So I'll be diving deep into that in my channel and my newsletter, so check them out. But for now, just know this. Smart investing isn't just about you buying, it's about when you shift. Remember to comment down below your personal best ETF combination to see if it's actually better than mine.